I was interested in talking today about some high level concepts here because we've seen that this summer melt up more or less has continued. It's been a little bit more bigger price ranges over the past week or so, but we're effectively looking at a market that's close to closing at new all-time highs today, at least if you're looking at the triple Qs.
Sure.
So I want to build on the conversation you and I had on Sunday night, Tom, talking about frothiness versus bubbles. I noticed yesterday that CTA positioning, trend followers in equities, has reached the 100th percentile over the past 20 years. Basically, everyone who's long is long in this market. How does one...
hold on one second. When you say CTA, commodity trading advisors?
Yes.
Okay. I just want everybody to know what that term means. So that's people that manage commodity funds, futures funds, not equity funds.
Right. So futures traders are basically levered to the hilt right now, long stocks. And so we talk about a market that's getting frothy here.
CTAs, not futures traders. There's a big difference.
Well, CTAs operate in the commodity space, and
they totally operate in the commodity space, but they're not traders. These are money managers. But I agree with you, and I'm listening to your point. Go ahead.
But what are money managers supposed to be? I mean, when do they? I mean,
no. Go ahead, Chris. Keep going. Then Tony then we'll listen to Tony's part.
So positioning is stretched, right?
Yeah.
I can't help but see that the breadth isn't strong, though. The Russell's obviously taking the baton a little bit today. If interest rate cuts are coming and the September cut odds look like they're firm right now, then small caps have a little bit of a tailwind. But at what point do we say that this is going to a point that it's frothy enough to start shorting? Because at the end of the day, low volatility, positive technical drift, it's very difficult to ignore a bull market in those regards.
I think we're there right now. I think we're about to get to a level that, well, here, I'll let Tony, because he had a point. Go ahead.
Well, I mean, they're all supposed, I mean, anytime I've ever given or family members have ever given who don't trust me any money to any type of money manager, when do they get you in the market? Typically immediately, if not sooner. Like that's when they allocate you into everything that they have. And they might put you a little bit more aggressive or a little bit more conservative. But as markets go to all-time highs, they got to play catch up with it. So they're always, chasing the tail of the dog if they're behind the eight ball by going less aggressive. That's why they always basically cut it down the middle and go somewhat moderate to aggressive so they can keep up with the market and really not overperform the market. So I think they're just playing catch up in my eyes. But I agree with you. I think the market, has gotten to a point where you're going to see you would expect to see a little downside capitulation. But volatility is telling you not yet, even though the E-mini S&Ps just sold off 20 some odd handles.
I think we are about to get in. I think today is going to be this morning. I said it earlier to Tony when the number came out.
We were going to be unchanged, right?
I think this is going to turn into something that's not very pretty. And I think this is going to turn into something that's not very pretty. I'll just leave it there. And I think that is what you just talked about is probably one of the more interesting statistics, because I don't remember a time when commodity trading advisors were all in.
All in right now. And you have that feeling. If we had broken down the CPI report, I could give you some numbers to support that feeling, but we're not going to do that. I'll save that for Ilya.
That's fair.
It's not so much that. I think that what Chris and I talked about Sunday night was he asked me if he thought we were in a bubble. And I said, no, I don't think we're in a bubble. I think...
You said frothy.
I said 1999, 2000 was a bubble because you had a lot of cheap-ass, crappy companies that were just stupidly priced. I think in 2008, we were approaching bubble-like conditions because we got volatility down into the 9 handle. I think in 2018 was really weird because we had no sell-off in 2017 of even 1%. So had this pent-up sell-off demand. And then I think in 2020, the pandemic, the timing of everything, that 35%, sell-off in basically just, 5 or 6 weeks was the violent reaction to having had no sell-off in 4 or 5 years. And then, obviously 2022 was kind of a little more of an extended sell-off, but then you had the real damage, last August and then this April. when you saw kind of what a violent sell-off can look like. But we've had nothing that has been sustained. And I think that this market has been given a grace period, and it's gotten to the point now where I don't think, because the companies that are leading this market are big names, and they're big names, they're real companies, and I don't see them as, as bubbly. I see them as frothy. And I think there's a very distinct difference.
Tony, wouldn't you say that in a bubble market, everything inflates, not just pockets?
I mean, historically, sure. I mean, but haven't we seen that? I mean, I think when we had the meme stock mania, that was more bubblicious than anything that we've seen in the equity markets here. Volatility's low, but not low enough to get into the 9-10 handle like Tom discussed. So we're kind of in like a Goldilocks here. I mean, it seems like it. I mean, until further notice, like I've always said, I'd rather miss the top 2 days of the market than continually look to sell the market and get the top, because I think fortunes are.
Well, even if you miss the top 2 days for the last 15 years,
100%,
you didn't do very well because the market turned around and rallied.
No. Even when we went down in April, I thought we finally were going to get some two-sided chop sideways, maybe even make lower lows and then go higher. I didn't think we were going to have another one of these kind of V bottoms that we've had. 100%. 100%.
Yeah, I remember you took a spike trade after you and I spoke on Let Me Explain a few months ago. Got long ES at 51.71.
Yep.
So I do think there's a difference between froth and not froth, but I also think that the market has, there's an incredible amount of across the board complacency. Otherwise, you wouldn't have commodity trading advisors at fully invested, and otherwise you wouldn't have. I think the amount of institutional cash on the sidelines is really small right now, but I think that the amount of retail speculative cash is actually quite large. Mm-hmm. And so I do think that there's that. I think retail investors are smarter than institutional investors. I think the public can see it, and I think they are sitting on a lot of cash. I can tell you right now, like just from my position, Tony's position, and a lot of other customers I know, everybody's sitting on a lot of cash. So I think retail investors are sitting on cash. I think institutional investors are fully loaded. As your CTA argument, it kind of supports that argument, and it also, I think it goes across the board. So I think that retail investors are actually in a pretty good position. They're just looking for more speculative bets, and I think that the other side of the market is very different, and the institutional market is knee-deep because they're all playing catch-up with each other. You can't sit it out.
It's interesting that you talk about money on the sidelines here, because there was a chart that was going around last week that cash on the sidelines has hit a new all-time high. I think that's one of the most toxic bull narratives that's out there. I'll give you an example. Let's say I have a box that can put 10 things in it, and I have one thing that goes into the box. It's taking up a tenth of the size of the box. If all of a sudden I have now 10 things in the box, I have to wonder, is the box the same size? What if it's now able to fit 100 things? As a percent of overall money floating around in the system, invested in stocks, in bonds, in crypto, blah, 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 cash on the sidelines is not at a high level whatsoever. As a percent of the overall equity market cap, it's actually quite low.
I think the distinction here is that retail cash, from what we can see with retail traders, because I don't know, whatever Tasty has retail trader wise, $7-8 billion of retail customer, funds. I see that a lot of it is on the sidelines right now, waiting for opportunity. I think on the institutional side, it's a very different game. I think if you're an institutional money manager, if you're not fully invested, you underperformed, and B, you don't have the ability to pick and choose. You're pretty much trapped by your peers. So if Chris Vecchio misses a move in the market, nobody gives a crap. Okay, it's Chris Vecchio. If Tom Sosnoff misses a move, nobody cares. Okay, it's my own money, it's my own life. Nobody cares. Okay, but if Chris Vecchio, the money manager, misses a move in the stock market, you're out of business.
Yep.
And so there's the motivation for CTAs and RIAs and everybody and every other portfolio manager is that you have to keep up with the Joneses. For individual investors, I don't give a rat's ass what how much cash Tony Battista has on the sidelines.
Sure.
And nobody does. There's no customer anywhere. So the customer, that's why I say there's a ton of customer capital seeking speculative upside. And when they think there's an opportunity with like high volatility underlyings like Ethereum or some crazy, IPO or whatever it is, they're all freaking in. But if it comes to other stuff, I think those are mostly institutions and they're not retail. And I think that is the distinction. And I think, you hear that on Tasty, but you don't hear that anywhere else because nobody else can distinguish because nobody else really understands it.
Now, this is a point that Ilya and I talk about all the time. If you lose money in a bear market as a money manager or hedge fund manager, everyone's losing money. If you lose money in a bull market, you lose your job.
You don't
the incentive structure is a little bit different.
You don't even have to lose money. You have to just not, you have to underperform the whatever the tracking index is. There's only a few money managers. So one of the reasons that Warren Buffett is Warren Buffett is because he earned the right to underperform. Because people that put money in with Warren Buffett 50, 60 years ago, they don't care. Okay. Right. They literally do not care. I mean, Warren Buffett doesn't have to keep up with the averages because all they know is I put money with Warren Buffett. I put $100,000 in 1972 and now I have $100 million. I don't give a crap what that guy does. And that's exactly how they should think. But everybody else, you're only as good as your last quarter. So if it's Tony Battista, money manager, or Chris Vecchio or Ilya Spivak, money manager, you have one quarter to prove yourself. If you're Warren Buffett, it doesn't freaking matter. So that's why somebody like him, he can wait it out no matter what. But everybody else, you got to be all in. You have no freaking choice. And the way the market's been over the last 15 years, you can't even afford to get out on a down move. And that's why they all panic at the bottom because then they get scared at like 10%. But between where we are today and 10% lower, there's nothing you can do. You got to just ride it. You can't get out because if you get out, you're going to look like a fool.
Well, that's what happened in April, right? And then the market, basically people had to pile in and chase the market higher to,
of course,
fix their underperformance.
Of course. So it's another reason why I'm so bearish right now is because I don't like the dynamics of where we are. I don't like the fact, I think the retail investor is going to be right. I think the retail investor is going to be pretty much on the sidelines until there's really a good opportunity. And I think it's going to be the institutional investor here that gets caught.
You mentioned that retail traders have a good deal of money on the sideline right now. And given the low volatility, that kind of makes sense. That's our ethos, right? When it's raining, that's when you go out. But when it's sunny, put up the barriers before the floodwaters come in. Terrible analogy. Let's just go with the question, which is, what's the most common mistake that you think retail traders are making right now in this low volatility environment?
They might be chasing stuff, but let me explain why that is, because I think people...
Sure.
And NASDAQ's actually down on the day now. Pretty wild. So let me explain this for Chris, because it's interesting. Mm-hmm. Over the last 25 years, since we originally built Thinkorswim, since we got the retail side of the business, there has been this huge transition from being like traditional stock investors to being much more strategic for retail investors because they become capital efficient. Markets are too expensive for retail investors to just buy stocks now. Nobody wants to spend, you're not going to buy 100 shares of Spiders for $64,000. That's bigger than most accounts. So people have become smart and they use derivatives now. They'll buy a call spread, they'll buy a call, they'll sell a put, whatever. They're much more capital efficient now. So for the customer that used to put all this money in the stock market, they now have a different approach where they're much more capital efficient. So they use their capital much smarter and they use other products. So it's hard to really judge what the retail investor is doing. But I know over the last 25 years, we have made the retail investor really freaking smart. We've made them capital efficient. We've made them understand products and strategies. And we've made them smart about investing. The institutional investor is in 2025 just as dumb as they were in 1975. They're still Neanderthal, like they're knuckle draggers. The institutional investor hasn't moved a bit because they've just been paid by a bull market, so they think they're geniuses. I think you're going to see a rude awakening for the institutional investor. I think the retail investor, they have better technology, they understand strategy better, they go play all the different markets, and they understand what's going on in the marketplace, and they are they're able to transition so much quicker that the next ugly move in the markets, the retail investor is going to be just fine. The institutional investors going to get their fingers chopped off. And I'm just telling you, they haven't,
because of the duration of their trade, you're saying.
They haven't evolved. Tony, they do the same crap they were doing in 1985. The retail investors got like the coolest technology you've ever seen. They're all over the place. They're doing every strategy. They're totally capital efficient. And they are truly Neanderthals on the institutional side. They should be ashamed and embarrassed, but they're not, because the bull market has made them into millionaires and billionaires in some cases. But it's all garbage. All right, enough of a rant.
We've been doing Let Me Explain for a while now. That was the first time I was able to get you to say the words "Let me explain" in one of your answers.
That's fair.
I mean, but are you trying to explain the bull market? I mean, is that what you're trying to say?
I'm not trying to explain the bull market. I'm just saying
criticizing the bull market.
No, I'm not even criticizing it. I'm just saying. I'm saying.
I mean, it is what it is. I mean, we treat what's in front of us.
Right. I'm saying it's a little frothy now. That's all. I'm trying to explain. If the market turns, I'm actually making a very strong case for the retail investor. Like, I think they're going to do okay. And if the market turns, I think the institutional investor is going to get caught. That's all.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.